In WinTax 2016, we've introduced a new option to the financial tools icon, the South African flag. If we click on that, the first option here is unit trusts, which shows the advantages of a unit trust investment and especially the tax advantages of investing in unit trusts. Let's have a look at this calculator. To illustrate the advantages of a unit trust investment, let's have a look at an example where a client wants an investment which will supplement his pension plan when he retires in 20 years' time. This simple calculator consists of two tabs. The first tab will allow us to calculate an estimated maturity value after investing in unit trusts for a certain period. And the second tab will show us how the maturity value or capital will provide regular monthly income. Looking at the first tab, we enter as an example a monthly investment contribution of 1,000 Rand escalating at 10% per annum for 20 years or 240 months. I'm using a 10% escalation here to build up capital while the investor is young and still working. We entered a growth rate of 10% per annum in this example, and I think most financial consultants will be happy with 10% growth, but you're quite free to enter whatever figure you choose. The growth rate we enter is an effective rate, and the program will take the effective rate we enter and convert it to a nominal rate compounded monthly for use in the calculation. In other words, the calculator will take the 10% growth rate we enter, work out a nominal rate compounded monthly, and use 1/12 of that as a growth rate per month. If we click on the default rates button, we can set up costs and fees for different types of unit trust investment products. You can see we've set up an annual distribution amount of 2%, an annual management fee of 0.5%, and a consultant trail fees of 1%. Once again, you can change these values to anything you choose. If you're dealing with a fund that says the growth rates they publish include all costs and fees, then you can set all these values to 0. You can see the calculator has worked out the total contributions made, the maturity of capital growth only, plus with distributions reinvested. We have an estimated maturity value of 1.707 million, and the proposal is that after 20 years we stop paying premiums, we leave the sum in the fund, and now start drawing monthly income instead. Although we started off contributing 1,000 Rand a month, after 20 years of escalating at 10% per annum, our last contributions would have been 6,724 Rand a month. Let's have a look at the second tab on this window, showing how our capital and income will fare. For example, when the investor gets to retirement age and wants to use the capital to generate income to supplement his monthly pension plan. You can see our 1.707 million capital carried over here in the yellow field. We can enter any amount we wish into the white field here to use in this calculator, but let's copy our 1.707 million maturity value into the white field and use that amount as our capital. We can also say that we expect our money in the fund to grow at 10% per annum, just as before. I have entered that we will start off drawing 11,000 Rand a month, escalating at 6% to counter for inflation. This 11,000 Rand monthly income is 11 times what the investor paid in contributions in the beginning when the investment started, and the 11,000 Rand a month increases at 6% per annum to keep pace with inflation. Let's have a look at the default rates in this calculator. I think most brokers will go along with the costings and fees I'm using here, but you can change these settings in the calculator to whatever you wish. The table shows us that after paying us all this income, our capital will provide the inflation-linked income for over 21 years. In fact, if we open the amortization window, this table shows us everything on a monthly basis. Looking at the first month, we can see that after drawing 11,000 Rand income and after adding 1/12 of the nominal value of the growth rate and adjusting for trail fees, we are left with a capital of 1.692 million. If we scroll down to the end, we can see that the income will actually be provided for 258 months, which is 21 years and 6 months. And after 21 years, our monthly income will be 37,395 Rand. This type of investment has another big plus. The income is tax-free in virtually all cases except where your taxable income is very high. You see, what happens when you draw income every month is that your investment fund sells enough of your units to pay for the income you draw. The tax implications are of a capital gains nature, and you only pay CGT on the profit you made when your shares were sold for income. Have a look at year 1. Our income for the year was 132,000 Rand, but we're only liable for capital gains tax on the profit we made. So the question is, what did we pay for the shares when we bought them? SARS has 3 different methods they use to determine the base cost of the units we sell to realize income. Specific identification, a weighted average method, and a FIFO or first in, first out method, where they say that the first shares you sold are the first shares you bought. You don't have to worry about any of this, as local investment funds have extremely sophisticated software that keeps track of exactly when you bought and sold units and the price. You will receive certificates showing your amount for capital gains and for any other distributed earnings. The thing I want to stress here is that whatever method is used, the transaction of selling shares or units is very tax friendly. Using the FIFO method, the 132,000 Rands worth of shares we sold in the first year of drawing income would have cost us about 20,000 Rand when we bought them 20 years earlier when we started the investment. Our profit is thus 112,000 Rand. But wait, it gets even better. The current CGT laws say that everyone gets an annual exclusion of 30,000 Rand and only 33.3% of the balance is taxable as normal income. The 112,000 Rand profit less 30,000 is 82,000, and 33.3% of 82,000 is 27,000 Rand taxed at normal rates. This 27,000 is way below the tax threshold for paying tax, so if the 132,000 Rand is our only income, then we pay no tax at all. Looking at year 20 here, we cashed in units to the value of 399,000 Rands, which cost us about 60,000 Rand when we bought them 20 years earlier, giving us a profit of around 339,000 Rand. After the annual exclusion of 30,000 and applying the 33.3% to the balance, only about 103,000 would be added to taxable income. The tax threshold for people 65 and older is higher than this. Considering the thresholds where incomes become taxable, one would have to earn a lot of income from profits on share sales to pay any extra taxes. Even share profit income of 100 million Rand a year would mean an effective tax rate on the 100 million Rand profit of only 13.6%. If all of our income consisted of share profit income of 500,000 Rand in a year, it would be taxed at an effective rate of 1.5%. For taxpayers over 65, the effective rates would be even lower. It is true that there may be a small amount of income by way of interest income, but this is generally very little and, in most cases, negligible. Have a look at the two buttons on this screen explaining effective tax rates and the interest portion of income. The specialist analysts managing unit trust funds have uncanny skills. They use to plot and predict market movements, and they shift money around to ensure the very best returns for the funds and ultimately for the investors. In cases where these analysts think that share portfolios may look like they may temporarily suffer poor returns, then your money may even be moved to bank investments for a while, where your money may be subject to ordinary bank investment rates and earn interest. The interest will be passed on to the investor as normal taxable bank interest. If you have R1 million of your money moved to a bank investment account temporarily for a month where it earns 6% per annum, then your 1 million will earn 5,000 Rand in ordinary bank interest taxable in your hands. As the first 23,800 of bank interest for not yet 65s and the first 34,500 of bank interest for 65 and older is exempt from tax, you can see that you would need to have a lot of your money moved to bank investments for a long time for interest to become a factor. Now let's go back to the first tab. This calculator offers very useful what-if scenarios. What if the investor started investing 10 years earlier with contributions of only 500 Rand per month? In other words, instead of investing for 20 years from age 40 to 60, the investor started at age 30 with an investment of only 500 Rand a month. We can see our estimated maturity value would be over 3.4 million. Now let's have a look at tab 2. We can see here that drawing as much as 22,000 Rand a month inflation linked, that this income would last for more than 22 years. And 22,000 Rand a month is 44 times more than we contributed every month when we started this investment. Obviously, the figures produced by the program must not be construed in any way as any form of quote or guarantee of what the investor may receive. Having said that, it's very difficult to sell any investment product if you cannot show the investor what he can expect in return for his money. It is this calculator's function to provide the investor with an estimate based on variables you enter. Our calculators use standard accounting formulas, and the values that these calculators produce can be hand-checked using an ordinary calculator. We are using a constant growth rate of 10% per annum in our examples, and we are assuming that the growth rate will remain constant for the entire term of the investment. We all know this is not going to happen. There may be periods when the growth rate may be less than 10% per annum, and there may be periods when the growth rate may far exceed 10% per annum. Nobody can predict what growth rates will be in 5, 10 or 20 years from now, and the same thing goes for dividends which may accrue. We have to bank on a certain degree of stability in the markets and look at what the share portfolios have produced in the last few years and what they are producing now. Strict laws governing how much of a fund's money may be placed in particular company all go towards protecting the investor's money. For example, if these laws restrict an investment fund from placing no more than 5% of your money in a copper mine, and this copper mine suddenly goes under completely, then only 5% of your money would be exposed to this loss. Using portfolios of baskets of different unit trust funds as an investment medium to provide additional income at retirement can be a very good investment. Share markets tend to move up and down in cycles, but over time the general direction is up. The cycles can have a distinctive bearing on the maturity value of this type of investment. Cashing in units at the top of a cycle will mean a greater yield compared to selling units when share prices are low. Provided that you're reasonably flexible about when you want your money, then a unit trust investment may be a useful additional investment with excellent returns over long periods to supplement your pension plan.